Good day. Despite facing challenges, 2023 was surprisingly a favorable year for investors. As can be seen by the orange lines on this slide, both equity and fixed income asset classes ended the year in positive territory in USD, surpassing expectations and outperforming inflation and cash. Key highlights included developed market equities returning 23.8%, emerging market equities returning 9.8%, and global government bonds returning 4%. Whilst gold reached an all-time price high, posting 13.1% annual return, commodities experienced notable declines on the back of falling oil, metal, agricultural prices. Notably, gains were concentrated in the final 2 months of the year, with equity and bond markets reaching their yearly highs by mid to late October. Most bond markets had negative territory for the year, but rebounded on the back of falling bond yields post the dovish policy pivot by the Fed. Within equities, the concentration of returns was extraordinarily within the Magnificent Seven, the US technology stocks returning 75% for the year. Excluding these 7 stocks, the rest of the US market achieved 15% return, compared to the 26% when including the Magnificent Seven. These robust performances across all asset classes led to a significant rebound in the performance of our 3 global multi-asset portfolios, not only during the last quarter of the year, but also for the entire year. It is also noteworthy that 2 of the funds have successfully met their return targets with their specified investment timeframes, notably the Global Managed and Global Growth. Looking at the Global Cautious, the fund had a strong quarter in absolute terms, outperforming its global cash target by 4.5%. As a low equity multi-asset portfolio, the biggest contributors to returns was the fund's 56% allocation to fixed income, which added 4.5% returns, and the fund's equity allocation, which added a further 2.6%. On a relative basis, manager selection contributed, whilst asset allocation overall was a detractor. Looking at the Momentum Global Managed, our balanced portfolio, the Global Managed portfolio also had a strong quarter, outperforming its global cash target by 4.2%. The biggest contributor to returns were the fund's 58% allocation to equities, which added 5.6%, while the fund's fixed income allocation added a further 2.2%. On a relative basis, manager selection contributed, while asset allocation overall was a detractor. And finally, the Momentum Global Growth Fund also outperformed its global cash target by 4%. As an aggressive asset allocation fund, the biggest contributor to returns was the fund's 88% allocation to equities, which added 8.2%. On a relative basis, the portfolio's bias towards Japan, UK, and China was a detractor, with these equity regions underperforming the broader global equity markets. Similarly, the portfolio's 4% allocation to cash detracted due to strong up market, which meant the portfolio would have been better off if it had been chosen to be fully invested. Looking at 2024. In 2024, we anticipate a notable decrease in interest rates by the year end, with prospect of further cuts in 2025. Whilst this adds a positive dimension for risk assets, caution is advised due to the many market uncertainties and the substantial late 2023 surge in bond and equity markets that has led to elevated valuations. So, after a highly unusual year in 2023, with returns heavily concentrated in a narrow range of stocks, we believe that caution and a high degree of selectivity is required in 2024, which should increasingly favor an active investment style and diversified positioning which we employ within the Momentum Global Managed Solutions range.